All right, what up, traders? Jeremy here, coming at you for the market bias update report for Sunday, December 10th. It is 4 p.m. right now, Pacific Standard Time. So you can see we just opened on futures about an hour ago. And on the S&P 500, we did actually gap up over the weekend here, officially setting a 1-year high. This is a 6-month chart. If I toss this out to a 1-year daily, you can see right here, we have now officially hit the high point for the year, taking out the highs that we had back in July. So obviously very, very bullish on the major indexes. We are still overextended on the RSI. We did get a little bit of a pullback here last week and spiked higher again. With that, you have to take the RSI with a grain of salt because it does show that we are overextended, but it does not mean that we are done with the bullish move. That is a misconception that a lot of new traders have that, oh my gosh, it's showing red, it's overbought, and therefore it has to come back down in the short term. That is not true. You can see back here, we were overextended from, basically June through basically for 5 weeks in a row, we were showing overextended here, and yet we were still moving higher and pushing higher. So we can move higher from here. Does not mean this bullish move is over. I do like the MACD moving average convergence divergence graph here is actually trying to signal a new bullish leg potentially starting. And the real interesting thing on the S&P chart, if we go out to the weekly, right now on the weekly, we have this big cup here, this handle here, and the neckline right there that we are now gapping out and breaking above. So to me, there's really nothing, especially on this weekly chart, that is going to stop us from trying to come back up here to the 4,800 level, matching an all-time high in the S&P. So watching to see if this can hold on that chart, and really just looking for this as an opportunity to play the upside. Now, because this index is overextended, I am not personally going to be looking to play the S&P 500 on its own. Instead, I'm going to be looking for stocks within that area of the market that have nice, clean entries and really good stop loss placements to be able to play some catch up on some stocks that maybe have not experienced that gap yet going into this week. Going out to the NASDAQ, we're going to see very, very similar, just gapped up again, new little high here on the 6-month chart. Toss that out to a 1-year, not a 2-year, 1-year chart, new all-time high for the 1-year. Same thing, overextended here on the RSI, and MACD still looking like it is trying to put in a signal for a new bullish movement. And if we go out to the weekly, again, very, very similar to the S&P. Now we are targeting up here to the all-time high, which is at 16,767. So don't see any reason why we will not make that next push. We did take a little bit of time off and consolidated, touched the 9 last week, bounced back off of it, and now have broken out from this all-important level, confirming that cup and handle, and now looking towards all-time high movement. Now, this is important because last week in our little market bias update report, I had said that we'd had a ton of catch up in the smaller names within the market, and we really needed to see them chill out for a little bit because they had moved so hard and so fast, and that we needed to look to the mega caps, the big tech names for that next leg higher. So if we go out and let's just look at Apple here, and let's go to daily charts. So on Apple, we had a nice consolidation pattern here, broke out, consolidated again, testing to make sure that we could hold those levels, and then break out on Friday. Don't see any reason this can't hit the old all-time high at 198.23. And honestly, when Apple gets going, it tends to move. And if it can take out that level, I don't see any reason why we couldn't get up to the 205, maybe even 210 arena. Just looking back here, the last big bullish run that we had, we really went up about $66 or almost 50%. So if we take that from the low here and look at where we currently are, we're up about half that Again, I don't see any reason why we couldn't come up to that 205 or 210 level. I really like the look of Apple going into this week. Same thing for Amazon. We've had this nice consolidation, time off on the daily chart. On the weekly chart, we look back and we are breaking out or trying to break out of this previous pivot here. I don't see any reason that we would not continue up to about 160. If we break 160, probably going up all the way back up to 170. So there is a really nice potential for a trade there on Amazon as well. And I could go through a bunch of other tech names as well on that. NVIDIA, for example, took some time off, consolidated, pulled back into the 50-period moving average here, confirmed a little kind of king's bed analysis, a little low base here on the 50, confirmed that as new support and are now breaking out. Anything triggering above the 20-period moving average around 480 and 27 cents. Let's just call that 480 and 30. If we break out 480 and 30 cents, I don't see anything stopping us from coming back up and testing the highs at 505. So good potential trade there. And then let's jump back in because honestly, I could go through tons of other tech stocks right now that are all showing that same thing. I think you get the idea. There is probably going to be some pretty significant opportunity in the tech space. That's probably going to be where I am focusing this week. So going back to our NASDAQ chart, again, don't see any reason that we might stop here between where we are now and that all-time high that I have the alert set here at 16,767. If we do take a day or two to go sideways here after this gap and consolidate that gain, it wouldn't be the worst thing in the world. And I would be looking at a trigger above any consolidation we get there. Going out to the Russell. Russell gapped up as well, confirming off this new level of support right there. Don't see anything really that would stop us from getting back up into maybe the 1935, 1940 range. We do have a longer term diagonal resistance zone there that might play a little bit into this. That is where we hit our head last time. We had a nice big rally. This time, I kind of have a feeling it's going to play out a little differently. I see maybe a little bit more consolidation right here, and then probably a power move moving back up to this previous resistance zone. And this is a very important resistance zone right there, just above 2000. So I'm kind of targeting the small caps back up to 2000 in the next couple of weeks to end the year. So let's see if we can get that. But on the daily chart, it looks really good to me. I don't see anything that would stop us really, other than maybe a day or two's consolidation right here that basically plays into this high right there as well. So, you know, kind of consolidating between the low of today's candle up to about 1925, and then a break above that, moving back up to 2000 or 2020, somewhere right in there. Going out to the Dow Jones. Dow Jones gapped out, had a nice consolidation, touched the 9, breaking out. Again, very similar story. Don't see anything really standing in its way, getting back up to the all-time highs, which it is actually almost at right now. All-time high is 36,832, and we are currently at 36,678. So not a whole lot of room here before we hit all-time high on the Dow Jones. To me, this one is quite a bit more overextended, and I think this needs some time to chill out. This has been a monster run, so I would not be surprised to see us hit our head on this all-time high and give a pullback at least into the 9-period moving average, if not maybe even a deeper pullback, multi-week pullback, back down into the support around 35,700, somewhere right in there. Anything playing off that level would be playable to the upside there, but I think this chart specifically needs some time to chill out. If we go out to UUP, the US dollar, so this is an interesting chart, and this one is going to be one that's very important for us traders, especially on the short term, to keep an eye on. We did have a decent pop up on strong economic data this last week, and honestly, I am not very excited about seeing this higher pivot low on the US dollar. This is the one thing that might bust the tech trades moving into this next week, and honestly throughout the rest of December. If we put this out to a weekly chart, you can see we had this nice pullback. We came into the 20, and so far we are holding that 20-period moving average on the weekly as support. we really do not want to see this pick up momentum to the upside. If it does, that is going to slow down the breakouts on the tech sector that we are looking at. So that is the one threat that I see right now to the potential tech trades moving into this week. And all that means is when we are looking at breakouts, let's say on Amazon, we need to have good stop placement. We have to have good control over our risk, right? So breakout on Amazon, for example, if we got out above, let's say 148 and 60 cents, I would stop just below the 20 period moving average. I'd probably stop somewhere around 144 and 50. And then targeting out to 159.50 and ultimately 170. So still really good potential reward to risk here, especially if we get some momentum like we did last time. We bounced off the moving averages, but we need to have our risk management in place if we are going to trade this, just in case the overextended conditions in the tech sector as a whole end up adding to the resistance conversation, and also if the US dollar does in fact break out. Moving out to some of the metals, platinum is interesting to me here. I don't see any reason that we shouldn't confirm higher here and come back up into this diagonal resistance. This diagonal resistance is played kind of key for the last 6 or 7 months. If we drop this out to a weekly chart and zoom in here a little bit, you can see we did pull back, came back, bought up all the way back at the end of the week and closed above the 9 and 20 period moving averages. And if I zoom in really tight right there, you can see the 9 moving average on the weekly chart has actually crossed back above the 20, that green line, back above the blue line, the 20 SMA, for the first time in quite a while. It has really been basically ever since the cross back here in June that we've been trending below that. So that is a bullish cross, and I am interested in playing some platinum potentially if we can hold that level and get a confirmation here on the daily chart. Anything above, let's just call that 926 and 50 cents. And I'm just going to go ahead and create myself an alert right there. 50 cents. If we get back above that, I might take a quick day or two play looking for it to come back up to that diagonal resistance line. Going out to gold, gold had a monumentous day last week and then just could not hold it. It got over its skis, came back down and pulled back into the daily rising 20 period moving average. We really want to see this hold as support. If it does hold as support and we get back above the 9, there might be an opportunity to play to the upside there, but I think this needs a few days to develop. I'm not super interested in jumping into this on Monday. I kind of feel like we need to wait a few days and see a base form here and really make sure this 20 period moving average is indeed going to hold as support. If it does not, we'd probably be looking at a deeper pullback down to about 1975, 1980, somewhere right in there. So confirmation that the upside is playable, or if we break down off that 20 period moving average and move back down to that 1975, 1980 level, I would be looking potentially for an add there. Silver, very, very similar. Silver tends to move faster and more aggressively than gold, but typically in the same direction. And we have already actually sold off all the way back down to the 50. If we get back above the 200 period moving average, which is right here at, let's call that 2360. If we get back above 2360, there could be potential to the upside there. But again, I would really like a few days of consolidation and a little bit of just seeing it settle down and losing that downward pressure momentum that we've built over the last week. So if we get a few days sideways and then a breakout, I would be interested in potentially playing that. And finally, let's go out to, well, let's do 2 more. Bitcoin has had a huge run. Obviously, very, very bullish, strong bullish momentum here. It's been holding its 9 period moving average, 2 days of pullback, and then fired off. Couldn't hold that breakout. We did close above the breakout channel here, but now we've come back down over the weekend, back into that range. Would be playable above 45,260. But honestly, I would like to see this just go sideways between these 2 alerts, anywhere between 43,355 and 45,260 take 2 or 3 days to just consolidate in there, let this 9-period moving average catch up, let the 20 catch up a little bit, and then rock and roll to the upside. That would be the bullish case. Honestly, to me, I'm more interested if this thing actually breaks the 9-period, comes down and tests the 20 as support. Hopefully it would kind of creep up here to this diagonal support line that I have drawn. You can see where I've drawn that channel line on the weekly chart here. But a pullback to that and letting the 9 weekly catch up and a test off of that 9 weekly converged on this diagonal support line, that would be a really, really good setup in my mind for the next bullish leg. I'm not as interested in playing this breakout just because I do feel like we are pretty overextended and have been for quite some time here on the RSI, but a pullback down into, let's say, 40,500 to 4,100, somewhere right in there, and then a confirmation candle to the upside, I would be really interested in. So tracking Bitcoin for a bullish retracement to be able to get back in and play that. And then finally, wrapping up here, let's look at crude light. So crude light has just been getting killed, topped out back in end of September, beginning of October, and it has been bearish ever since. A lot of this bearishness has been focused very heavily on the fact that people are expecting softening demand due to this impending recession that the market has been anticipating for the better part of 2 years now. We still have not gotten that recession. The bears keep saying it is coming. The bulls keep saying, you know, hold my beer, watch this, and jamming us to new 1-year highs on the S&P. I don't think that the price is justified down at the low levels that it is. I think this is a potential opportunity in the making, and I really like the MACD setup here. You can see if I zoom in a little bit on that daily chart and make this MACD a little bit bigger, you can see we had been trailing down on the MACD for quite some time here from, let's say, the highs. So all the highs on the MACD had been getting lower, lower, lower. The lows had been getting lower, lower, lower. And now, just recently here, we've started to see some divergence in the MACD where prices from right here till now have continued to go down, and yet the lows on the MACD from right here till now have gone up. And we are actually confirming here, looking like we are setting a new higher pivot low on the MACD. So that is classic bullish divergence on the MACD, which signals that this trend to the downside might be coming to an end. There's still some development that needs to happen in the chart, but keep an eye on crude light. If we toss this out to a weekly chart, and let me just clear up those drawings so you can see this a little bit better. We are now testing the 200-period moving average on the weekly chart here, and I really like that combined with this kind of support zone that we have from back here where we had all these wick tests down below, but just couldn't get below and close below that 200-period moving average. Again, we had it right here where we had a wick test below the 200-period moving average on that weekly chart, couldn't hold it, came right back up. This is telling me that the bears are potentially losing steam on crude light, and we might see a bounce here. As of the short term, I wouldn't get too excited about it. Any bounce probably would come up to about the 76, 76.40 area, somewhere right in there. But that is still a pretty sizable gain when you're talking about the move in futures. So if you do play futures market at all, keeping an eye on this, again, not quite ready yet, but a little bit more development. If we saw this kind of come up, hit its head on this decreasing 9, pull back again, back down into the same support level, and then come back up, give us a little W pattern right here, and then a breakout above that level, that would be time for bullish trades on crude light. So we're kind of looking for the development of this double bottom pattern resting on the weekly chart back here on that 200. So if we get that on the daily chart and confirm this weekly 200 as support, I think there's some really good opportunities coming our way in crude light. Again, need a little bit of development, but not a whole lot. Maybe 4 or 5 more days, 1 more week of development down here. If we can hold this level and then eventually break out of that 9-period moving average and move to the upside, that would be a really nice tradable setup on crude light. And honestly, again, you have to think about thematic perspectives in the market. And this is a little lesson for anyone that's new to the markets. When you are looking to bottom fish or looking to pick up at the lows after a big sell-off like we have had here, it's important to think about the themes that might drive the next bullish move. And to me, OPEC always has the market's back. They are going to do whatever they can on the supply side to make sure that they are not overproducing and they keep the supply tight, regardless of how much demand there is. And the bearishness in this chart has largely been due to the fact that people think that there is this impending recession coming that has just simply not materialized. And I think we have gotten overextended to the downside here. We've sold off more than I think is justified in this chart. So now I am watching for bottoming patterns here to play that potential break of this diagonal resistance in another week or 10 days probably, but good opportunity coming down the chute there. Finally, let's go out and check in on our heat map. So again, this is a heat map showing the percentage gain or loss over the past week for each of these symbols. And the thing that stands out to me last week during our market bias update report, again, I had talked about the fact that I think tech sector is about to come back online and might be where most of the money is flowing into in kind of a sector rotation. And we see here, Google, Meta, NVIDIA, AMD, Apple, Tesla. That is where we see the green. So last week, we did indeed see exactly what I was talking about. Money starting to flow back into these big tech sectors. And if that continues this week, that is going to drive the market higher and push us towards that next leg up in the general market. We also see the negative mostly in the energy sector over here. Big losses for ExxonMobil, ConocoPhillips, Schlumberger, Halliburton. All of these have gotten beat up pretty significantly, and I think it is about time for money to come back into that sector. So we're just waiting for a little bit more confirmation. But if we do get that bottoming pattern on crude light, I'm going to be looking at energy plays. And until then, I'm going to be focusing on the semiconductor and tech stocks moving into this coming week. So that is it for our market bias update report this week. Obviously, if you have any questions, as always, drop them in the comments, hit me up. I am here to help, and I hope that is helpful to everybody. Take care and trade safe. Make sure you have stop losses in place and keep an eye on that tech sector moving into this week.